there are still hopes that maybe we can handle inflation and not go into a deep, long-lasting recession. Are you optimistic that we can steer down that very difficult path, but it could be successful?
It could be successful. And you talk about giving advice to the Fed chairman. If I put myself in Chair Powell's position, I would be asking myself, what is the most critical piece of information I need right now to do my job? And I think the answer to that is I need to know what is the real rate of interest? What is if it were market determined, what would be the interest rate on loanable capital? And the reason that's important is because I've set up my whole strategy of fighting inflation on the basis that we need to raise the policy target rate to a level sufficiently restrictive to subdue growth, to decrease demand and spending, and to raise unemployment. So what I would be thinking of doing now is I go ahead, it'll be 4.4 by this afternoon, the rate the Fed pays on reserve balances. It'll be 4.3 on reverse repos, and that's how you set the Fed funds rate. But I need to know, is that sufficiently restrictive? So I need to know, is that higher than what the real rate would be? Because some people might say at 7% inflation, we still have a negative interest rate at 4.4. So I think that what I would be talking about is saying, now is the time to pause in terms of setting those administered rates and to start listening to the market. We need to fine tune now. Maybe we are close to that sufficiently restrictive rate. Let's engage in open market operations. Let's step up selling off that 8.6 trillion portfolio that we built up during COVID and let price signaling help us steer toward that soft landing. Let's start selling into market demand across the spectrum. We have 5.5 trillion in Treasury securities, 2.6 in mortgage-backed securities, and another $500 billion in other assets. Let's not try to manipulate the yield curve. Let's try to listen to the market and get a sense of how close we're getting to having the right interest rate. Because I think the aggregate wisdom of the people who are actually in the market is more reliable than my army of economists working here at the Fed.
Right. When was the last time you think we were getting completely accurate signals, price discovery signals from the bond market? We had the financial crisis. We had the pandemic. Have we had any accurate price discovery for the last 15 years?
I think we started losing that in October 2008 when, as part of an emergency package after the global financial crisis, the Federal Reserve received authority to start paying interest on reserve balances. Those are cash deposits that banks are required to keep at the Fed. And that number now, it used to be banks kept just a minuscule amount because they wanted to be loaned out. Well, now that's the best deal in town. So if you add up the 3.1 trillion that banks keep in overnight reserve balances, that's cash accounts, they're risk-free, government protected. So you're getting cash on basically what used to be a Treasury security. Now it's going to be, moving toward 5%, it looks like. And then they had to add the reverse repurchase agreement. So you're paying another 2.6 to money market mutual funds. So the Fed is paying all that return interest money, losing money while the Fed's doing it, on 5.6 trillion in cash. And the problem for me is, and this is why I would start going back to open market operations, you want that money to be more stable. It's on a hair trigger now. Let's say in the future the Fed says, all right, we're going to pause. And that money now says, we want more. We like this. We let that money sit all day and earn money on cash. And it's extremely liquid. So if they don't like what the Fed's doing, they can reverse all the good the Fed thinks it has been doing by cutting economic activity. All of that money is free to go elsewhere if they don't like the return they're getting from the Fed. I would rather do it the Paul Volcker way and have that liquidity soaked up, by firms saying, you know, it looks like those treasuries are a good deal. And they can lock them in at various maturities. But then the treasuries, those yields would start telling us something about the real state of the economy, the real cost of borrowing, and what the appropriate rate on loanable funds should be. And again, I would trust the free market determination of price signals on the most important price in our economy, which is the cost of capital. I would go that route, and that would be a good time for the Fed to start moving away from just setting administered rates by diktat and rely on market signals.